Welcome back, guys. Episode 3 now of the series, Forex for Beginners. Let's dive right in. So now we're going to be talking about one of the most important concepts in all of trading. Something that professionals use every single day for all the strategies and all their setups. Supply and demand. Now, this is not just theory, this is real market behavior. And once you really understand S&D, you will understand where and why price is moving a certain direction. So what is supply and demand? At its core, supply and demand are about one thing and one thing only: imbalance. Too many buyers and not enough sellers, price will go up. And vice versa is true. Too many sellers and not enough buyers, price will go down. It's very basic economics, just applied to the charts. So let's talk about supply zones. Think of a supply zone as a price level where there's a lot of selling pressure. Price hits that area and all of a sudden, boom, it crashes fast and hard. Why? Because there was more sellers than buyers. Simple as that. So when price goes back to that zone in the future, there's a very good chance the same thing will happen. There will be more sellers than buyers and the same reaction will occur. Price will crash. Now this creates a nice opportunity for us traders, a potential for a very sweet short. Now demand zones are the complete opposite of supply zones. It's a level in price where buyers came in before and pushed up the price aggressively. So when price goes back to that zone in the future, there's a very good chance buyers will still be there and still be in control. And that gives us traders a chance for a bounce setup or a long setup. So how can we as traders identify supply and demand zones? To identify such zones, we look for a few things on the charts. A very strong, sharp move up or down, and very big candles with little to no buildup. So price can be choppy for a while and all of a sudden it spikes upwards or it spikes downwards. Your job then is to mark the base of where that imbalance started. That base is your zone. It's where the imbalance began. That is where buyers or sellers took full control, depending on the movement, of course. If price moved away from that area before, there's a reason, and there's a pretty high chance it's going to react the same way when we get back to that area. So you might find yourself asking, why does price have to go back to that zone? I mean, if there was so much demand, why can't it just continue in that direction forever? And that's a good question, but that's not how markets work. There are often leftover orders. Not all big buyers or big sellers got their orders filled. So then price pulls back, fills those big orders, and continues on its move. Now that's why traders often call supply and demand zones magnets. Price gets pulled back to them before it continues its path. So what does this mean for you as a trader? When you understand the concepts of supply and demand, you stop chasing the markets. You wait for price to come to you. You start identifying key levels in advance. You can mark zones, you can plan setups in advance. It allows you to trade with precision, and it changes your whole trading game. Let's say price is on an uptrend, and it just made a very big push upward. Look at where that push started. Was there a small base? A little pause before the breakout. That is your demand zone. Now you can sit back and wait for price to pull back into that zone. If it gets there and you see signs of buyers stepping in, that's your entry for a beautiful long. S&D zones are what us traders like to call high probability setups. You're not trading randomly or guessing where to enter. You're entering at levels where the market already reacted aggressively in the past. And this gives you an edge over other retail traders. You're not waiting for specific zones and targets to enter. Now, supply and demand zones are about reading the footprints of the big players. Institutions, banks, hedge funds, billionaires. These guys move price in chunks when they enter, because when they enter big. And when you learn to spot the zones they left behind, you stop being the prey. You're now the sniper waiting for a precise entry. Okay, so let's begin to tie everything together now. You have the basic definitions of Forex. You know about trends and candlesticks. You know about supply and demand. Now let's help you build a trading edge. This is what separates the random traders from profitable ones. So what is a trading edge? Put very simply, an edge is what makes you profitable over time. It's your strategy, your rules, your ability to execute over and over again in a repeatable way. It's not about guessing, and it's definitely not about being right every time. It's about having a clear setup, managing risk, and being able to repeat it with discipline, even with a 50 to 60% win rate. If your edge has a good risk to reward, you can definitely win in the long term. That's the beauty of having an edge. You don't need to be perfect, and to be honest, you will never be perfect. You just need to be consistent and disciplined. So what's your edge made out of? Number 1, strategy. What pairs do you trade? What setups do you take? Number 2, risk management. How do you size your trades? Where do you put your stop loss? What's your targeted risk to reward per trade? And number 3, psychology. Can you follow your plan and execute your trades without your emotions getting in the way and ruining things for you? If even one from these 3 things are weak, your edge will likely crumble. Keep in mind, you do not have to trade every single market, every single pair, every single asset class. This is where many beginners tend to go wrong. They try to trade everything, every time frame, every market, try every indicator, crypto, Forex, stocks. Stop. You don't need 100 strategies. You need 1 to 2 setups that you can repeat, that you can understand, execute, and master. So this is exactly what you need to form your edge. Listen up. A clear, repeatable setup, defined entry rules, defined exit rules, a consistent risk to reward ratio. And number 5, the ability to execute this over and over again without changing your mind ever. Let me walk you through a very simple and basic edge that's incredibly powerful if executed in the right way. Let's say the market is trending upwards. Price pulls back to a very clear demand zone. A bullish engulfing candle forms at that zone. You enter a long position with the stop loss just beneath that zone, targeting a 1 to 3 risk to reward ratio. And lastly, you journal the trade and wait for the same thing to happen again and again. That's it. That's an edge. And if you trade only this setup and nothing else and journal your trades, you will start to gather data. You'll see how often it wins, you'll see what filters improve it, and eventually, over time, you'll know the setup like the back of your hand. Keep in mind, trading is not about being creative, it's about executing a boring, repeatable system. Real traders are consistent, not flashy. Once you master one edge, you can add more later on. But you earn the right to scale by proving that you can follow one plan first before moving on to the next. So if you're watching this video and you're serious about trading, forget about signals. You don't need signal groups. You need your own repeatable edge. Craft it, define it, trade it, and scale it. So now you understand supply and demand and how to build an edge, but none of it matters if you don't know how to manage your risk properly. In the next video of the series, I'll show you exactly how traders blow up their accounts and how you can avoid those mistakes.